Hi everyone, hope you're all doing well. Welcome to my portfolio and market update for the month of August, where I sort of discuss my performance year to date and also, how the market moved throughout the year and how we sort of positioned ourselves to take advantage and outperform the market. So, so this is my performance over the last 7 years, and I've spent the last 7 years building a strategy that blends sort of long-term conviction with short-term agility. So I mainly target high-growth sectors, and in the short term trade crypto, gold, and currencies. And I aim for about 20 to 25% annual returns while maintaining strict risk control. So this video will mainly focus on the economic landscape of the market this year and try to explain broadly the key drivers behind the major sell-off and rally we saw during April, and also discuss some of my holdings. So on this graph, you can see the Nasdaq, Dow Jones, and S&P. Year to date, we saw huge volatility in the markets from the graph, and you can see the Nasdaq, S&P, and Dow all moved sideways for a while until the markets dropped sharply around April. And this marked the biggest drop since the COVID pandemic, followed by a strong market rally, and we managed to take advantage of that dip right there. So looking at our portfolio's performance over the last year, you can see that we took advantage of the dip and bought into companies during the sell-off. And when the market bounced back, we saw significant profits, especially around April time. From April, sorry, and May, and we are still continuing to see some good gains today, allowing us to outperform the market. So to sort of discuss the year-to-date market behavior, if we start off at January, we saw a sideways to slightly positive movement as investors weighed softening inflation data against uncertainty over the pace of the Federal Reserve rate cuts. Trading volumes were thin early in the month, and the markets were digesting sort of mixed corporate earnings and a lot of geopolitical noise. By February time, however, sentiment did improve as policy euphoria took hold. You can see that there's a slight, positive movement as February kicks in, and the Fed's dovish commentary and early signs of global bank easing boosted risk appetite. So gains were modest, but this period reflected a wait and see sort of mindset, and it was sort of positioning us for for potentially a more supportive policy environment later in the year. Now around March, the market began to trend sharply downwards, marking the start of a broad correction, which was the key trigger being a sudden and aggressive shift in US trade policy. So early in the month, the Trump administration imposed 25% tariffs on Canada and Mexico, and they raised the tariffs on China from 10% to 20%. And these weren't just threats, they were implemented, and we ended up seeing the markets quickly react as investors feared things like rising costs, supply chain disruptions, and like sort of slowing global growth. Now, April, things went south pretty quickly, as on the 2nd of April, aka what's now dubbed as Liberation Day, the Trump administration officially unveiled sweeping across-the-board reciprocal tariffs, which ended up sending a wave of panic through the markets. The reaction was immediate. Equities tanked, volatility spiked, and risk assets across the board sold off. So just to summarize, from the beginning of the year, we went from a hopeful and opportunistic start of the year to now being in a highly reactive, protectionist policy environment that shook investor confidence and triggered a bond sell-off and sparked the most significant market drop-off since the 2020 COVID pandemic. Now, between the 3rd of April and the 8th, we saw temporary chaos. So you can see that there was a large amount of volatility as investors moved their money out of stocks. As expected, the bonds went up and yields dropped, and the US government said that their policy was working as their focus was to reduce the cost of borrowing. But then we saw something interesting. Investors started selling their bonds as confidence in US economic leadership was dropping. So we saw this, what's known as or what's dubbed online as bond vigilante behavior. So it's a sign that the markets are trying to punish the governments for reckless fiscal moves and to protest poor economic and fiscal policies. Then around April, the markets bounced back because Trump had temporarily paused the tariffs and investors speculated a possible reversal. So highlighted in red, you can see we saw the market surge and it was recorded as the biggest single day gain in years, with investors hoping a trade deal was near. Then for a short while we saw a pullback because of course it was all speculation and there were still unresolved trade tensions, and so no official trade agreement was announced at the time. So we saw some volatility as expected due to market uncertainty. Then from mid-April onwards, we saw a powerful and sustained market rally as several key factors aligned to supercharge momentum, which we were then able to capitalize on. So market rally drivers include, we had strong tech earnings across the board. Meta, Microsoft, TSM, Apple, AMD all beat expectations, and they reinforced this investor confidence in the demand for cloud technology, AI, and superconductor technology. And we saw numbers like the global cloud infrastructure spending was reported up 20%, 21% a year over year on year in Q1, telling us that enterprise demand for AI and data services was accelerating, and those were the sort of companies we were investing in. Adding to the bullish tone, the Fed signaled potential rate cuts for the summer, giving market green light to chase risk again. And on the political front, Trump softened his stance, pulling back on most of the aggressive trade threats and entering early negotiations, which helped restore that faith in economic leadership. All of this basically combined to flip sentiment from caution and fear to confidence and momentum. And as a result, we saw the Nasdaq surge to new highs, the S&P turned positive for the year, and we saw a broad participation across growth sectors. Throughout the rest of 2025, I plan to gradually diversify into healthcare, consumer staples, and energy to reduce my concentration risk while maintaining my exposure to growth. But this will be discussed in a separate video. Now, looking at the weaker side of the portfolio, there are several positions currently in a drawdown, but I'm maintaining them based on long-term conviction. Like Barrick Gold, for example, is down 12%. Gold prices have been pressured by easing inflation and rate cut expectations. So I'm holding it here as a hedge, expecting a potential upside if macro uncertainty increases or if we see renewed safe haven flows. Companies like Tencent is off nearly 10%, and Alibaba, both ADR and Hong Kong listings are down around 34% and 44%. This is largely tied to ongoing macro weakness in China and regulatory overhangs. But my thesis here is that these are fundamentally strong platforms with huge user bases, and sentiment could shift swiftly if Chinese economic policy turns more supportive. So I'm happy with keeping my positions here for now. Airbnb is currently down around 11%, hit by slowing travel growth, post-pandemic highs, and some margin compression. However, I see it as a structurally advantaged marketplace in global travel with strong brand equity and potential to expand into new verticals. In all these cases, unrealized losses are balanced by conviction in the underlying business. These positions give me more geographic diversification, particularly into China, and sector diversification beyond tech infrastructure. So while short-term headwinds remain, I'm positioning to benefit if sentiment and fundamentals realign in 2026 and beyond. So that sort of concludes my video. I will make a future video discussing future positions and what I plan to do for the last 4 months of the year. So that will be an upcoming video. I hope this was a good insight into my strategy. If you have any questions, please leave them in the comments below. Thank you so much for watching, and I'll see you in the next video.